Hi, I want this to be a bit more interactive. I want to understand kind of what you want to get from this presentation. So can I have a quick show of hands, people involved in social enterprises, social innovation, as a fundraiser, as a business owner? Can I get a show of hands well, thank you, Sam. Can I get a show of hands of students interested in coming into the field, either as a practitioner, as an entrepreneur? Anyone interested in investing in social innovation? Thank you, thank you. So I come from the perspective of impact investor. What is impact investing? Why impact investors and social enterprises can be a good match in allies, and then what do impact investors expect when they see a pitch, when they hear about a business idea? And then just some samples of some financing structures and possible investor exits. Do stop me anytime if my terms are unclear or if you have any questions. So just to start off with, my personal background, I'm actually a director in a real estate developer. And I've been tasked by my family to manage our family assets. And impact was something that came quite naturally for us. We had a philanthropic aim in our fund. And then we kind of saw, and why can't we make this a business? Why can't we look at this from a more critical eye? And hence, our thesis of becoming an impact investor came by to us. So up to this point, we've made around 50 direct investments in impact mission-driven businesses, and we're keen to keep growing this part of our practice. So just to start off with, this is the GIN Conference's newest definition of an impact investor. This was published last week in Paris. You can see that a lot of it is quite soft. It's about talk about social environmental effects, talk about positive contributions. But make no mistake, impact investment is about investing in impact and investing in financial returns. So it's not philanthropy. You can see that from the typical spectrum of impact investment. There's quite wide range. You start from philanthropy on the right side, so you can see the typical grants or government subsidies, all the way to capital finance, which is where Anson's comes in. Really financial returns, risk return measurements. Impact kind of comes more towards philanthropy, but I actually would put it more between like thematic investing. So we aim to not only say do no harm, we aim to choose good companies, but we actually aim to achieve specific impacts in the way we invest. This is quite an increasing trend. Why it's important for you to know as social entrepreneurs is that it's an increasing trend for both the philanthropic side and capital finance side to be aware of these issues. There's more and more people who, from the capital finance side, are aware of ESG issues. So how do you appeal to a capital finance funder and let him understand your perspective and speak the same language as them? And also on the philanthropic side, how do you take advantage of grants to make your startup scale more smoothly? So for example, why I think that the impact investor and social enterprises could be a match made in heaven. Generally speaking, impact investors can have a higher tolerance than regular investors because they have an expectation for social return. So part of this would be return. I would still seek market rate returns, but I might not push a certain company for growth because I'm looking for an exit. I will be a bit more understanding, I'll be a bit more patient, which brings me to the second point, liquidity. Regularly, if I was wearing my venture capital or angel investment hat, I would be aiming for something that would give me a 3 to 5 year exit. For a social enterprise, that's probably, depending on the business, that's probably not as realistic. But that's something that you have to be aware of when you're speaking with investors. They will be looking for an exit. If you're not aware of that, if you're not sensitive to that, then it might be very difficult to bridge that gap of trust. The risk that I'm willing to take is not a risk that, like underdeveloped business models, that I expect fully built business models that make sound financial sense. The risk that I am willing to take are untested business models in new geographies, or maybe using good, well-built business models in a new way. That is something that I would be more interested in. Impact investors are also not bound by more traditional philanthropic mandates. We can support for-profit business models, and generally, we make more independent decision-making process. So less red tape, much more flexible, much faster. And generally, as an investor and a social enterprise partnership, you have to look for the values alignment, because this is a very long relationship. When you start a relationship with an investor, this could be a 5-year, maybe even a 10-year relationship. You want to know that you're on the same page, besides the finance, because it will get tough at some points. It will get hard for you and for the investor to maintain a good relationship with the whole thing. But if you have the same values, you can work on it together throughout all this time. So, again, like I said, impact investment is not charity. If I was a social entrepreneur looking for a grant, I would appeal to their impact side of things. If I was a business, a startup, purely a venture startup, I would be trying to appeal to the finance side of fundraising. But unfortunately, because you want to be a social entrepreneur, you have to be good, you have to tell a compelling story on both sides. Not just one will make up for the lack of the other. So, as an investor, I would expect that a business idea that gets presented to me, the entrepreneurs can articulate the market gap and what their impact potential is. A line that I really liked from a more experienced entrepreneur, fundraiser, a need drives philanthropy, but need and opportunity drives investment. And don't forget, you're asking for an investment. Choose the right business model and to monetize on the opportunity. A lot of times I actually see great ideas or great impact potential, but maybe with the wrong business model. You have to understand why you chose a certain business model and why that works for you. A lot of times, starting a business might be quite easy because you have a very attractive idea, but you have to know what you need to do for it to scale and grow. Financial planning is a must. Even if you're not familiar with finance, you're not very personally familiar with it, make sure you find someone who does, a co-founder or ask for a professor's help. You will always find a way, but you have to make these plans, because otherwise you will not be a compelling entrepreneur when you're fundraising. You would just be flying blind. And as an impact investor, I would expect you to have very clearly defined impact and outcome goals. This is, again, I'm looking for both the impact and the financial returns. The last point about understanding obstacles really kind of echoes Anson's point earlier about integrity. The main thing I look at, ideas are never unique, but the team is unique. If you are the one who can make something successful regardless of all the difficulties, fundraising problems, politics, anything, I invest in the team. I invest in the people. The ideas, they will always change. So going into what impact measurement could be, it's quite difficult, because no two things are alike. No two businesses are alike. What a affordable housing startup in Southeast Asia could measure and report is very different from an empowerment program for new immigrants in Hong Kong. So what does this look like? Right now, the prevalent kind of big management tool, one of them is this called IMP, Impact Management Project. And it basically comes down very simply to a couple key things. What you're trying to do, who it will affect, how much, what is your undeniable kind of addition to the social situation, and what's the risk? This kind of seems very simple, but a lot of times people don't actually think through it enough to present their case. One tool that, as a social entrepreneur, you could actually come and use is a tool called Iris. It's actually quite foolproof. You could go through, depending on the business that you're in, and then you could click through, and it'll actually tell you the best practices of what is measured in similar businesses around the world. What's measured, how they use it, and how they present it. So money does not equal money. I've had more than a dozen times where an entrepreneur comes into my office and asks for money without actually knowing what structure is best for them. Generally, people always say, oh, I'm willing to give up equity. Why? Why are you willing to give up equity? Do you have a huge J-curve that you could satisfy, that it would make sense for the entrepreneur to take that level of risk? Because equity for an unsuccessful business means nothing. Grants, I'm not going to go into too much, but then there is really a role for grants in startups, in especially social innovation startups. Don't forget to use it. It's a very valuable tool, especially in the beginning, to help you get to the scale where you are profitable. Debt, again, like as Anson said, knowing when to leverage is important. It generally would be kind of cost prohibitive for most social entrepreneurs to look at debt in the beginning, but don't be afraid to use it when the timing is right. And one thing that I actually want to stress is be creative about your exits. Sometimes as an investor, I really like the idea, but they're very rigid in the way that they ask for money. Maybe they're only willing to look for equity. They're only willing to look for debt. But why? That's not being considered for the other side of the table. Demand dividend is I think it's a great example where you could look for ways to share your cash flow with your supporters, who are your investors. That ways that they have a more manageable timeline and exit. And you also have a supporter that will be working with you very closely. And the last thing is, why not bootstrap? If you can, why not try to survive on your cash flows alone? You don't necessarily have to raise money if you don't have to. And this is my last slide. I think if you're interested in speaking with impact investors, if you think that your business might be suitable to look for impact investing, there's a couple ways. AVPN being one of them. It's a great network for Asian impact investors. Our conservatory, or impact investment advisor, IIX, which is a platform where you can list your company for fundraising, and AVA, also a Hong Kong-based advisor. Sorry, I just met you today, so next time I'll add you to the slides. So yeah, that's it for my session. But if you have any questions, I'll be here around, and also for the Q&A. Thank you very much.